As of the market close on Friday, January 23, 2026, Supermicro Computer Inc., trading under the ticker symbol SMCI on the NASDAQ, finished the session at a price of $31.70 per share. This represented a notable intraday decrease of 2.31%, with the stock oscillating between an early high of 33.64 and a low of 31.33. While most investors are fixating on these immediate price fluctuations and the upcoming earnings report on February 3rd, the reality of the situation is far more complex than a simple cooling off after the massive AI-driven surges of the past. The insight that many are missing right now isn't found in the daily candle, but in the widening gap between the company's internal growth projections and the external skepticism from institutional analysts. Just 2 days ago, Bank of America reiterated an underperform rating with a price target of $34, suggesting that while the stock might look like it is stabilizing, the underlying margin pressure is becoming a heavy anchor. This creates a fascinating tension for anyone looking at investment sites or using the Robinhood app to manage their portfolio. The expectation is that because SMCI is a core provider for high-performance servers, it should naturally rise alongside the NVIDIA stock price. However, the reality is that Supermicro is facing a structural challenge in its profitability. While they are landing design wins in excess of $12 billion, their gross margins have slipped from 13.1% down to 9.3% in the most recent quarterly check. This is the curiosity loop that keeps professional traders awake at night. How can a company be so vital to the hardware side of the AI boom, yet see its net income per share drop from 0.67 to 0.26 in just a year? The common ground for most retail investors, especially those using Robinhood Investments or the SoFi Active Investing platform, is the belief that SMCI is a bargain at these levels. It is trading at a forward price-to-sales ratio of roughly 0.47, which is significantly lower than the industry average. But the contrarian view, supported by recent coverage from Goldman Sachs, is that this low valuation exists for a reason. Goldman recently assumed coverage with a sell rating, warning that there is very little clarity on how the company plans to fix its bleeding margins. They're shipping more than ever, especially with the new Blackwell Ultra and NVIDIA GB300 systems, but they are doing so at a cost that is eating their bottom line. If you're tracking this through Fidelity Wealth Management or Interactive Brokers trading tools, you've likely noticed the massive trading volume, which hit over 34 million shares in the last session alone. This isn't just retail churn. Institutional activity shows a massive tug of war. Vanguard Group and BlackRock remain the top holders, but we are seeing significant reductions from players like Morgan Stanley and Investco. When big money starts to trim positions despite record revenues, it signals a shift in the narrative from growth at all costs to a demand for fiscal discipline. This is a crucial distinction for anyone involved in self-investing. The recent daily swings have been particularly violent. We saw a brief rally earlier in the month following news of partnerships for AI-driven retail solutions, but those gains were quickly erased as Citi lowered its price target to $39. The market is currently in a wait-and-see mode, looking toward the February earnings call to see if management can substantiate their claims of a revenue breakout. Institutional investors are watching the $30 support level with extreme intensity. If that level fails to hold, the next psychological floor isn't until the mid-20s, which is a scary prospect for those who bought in during the peak of the hype. To understand where SMCI is going, you have to understand what it actually does. Supermicro Computer specializes in high-performance, high-efficiency server technology. They are basically the architects of the data centers that allow for massive-scale computing. Their business model relies on being first to market with the latest chip architectures from partners like NVIDIA and AMD. They don't just sell a box, they sell a total IT solution that includes the cooling, the rack scale integration, and the software to manage it. Historically, they were a low-margin hardware play, but the recent explosion in demand for AI servers was supposed to change that. The older reports from 2023 and 2024 showed a company that was doubling and tripling its revenue, which led to the stock being a top performer in the S&P 500 for a time. However, the transition into 2025 and early 2026 has been marked by accounting scrutiny and leadership changes. For instance, the transition of responsibilities from David Cao to Tom Xiao was handled smoothly, but any change in the C-suite for a company that has previously faced reporting delays makes the market nervous. This is why tools like Schwab Intelligent Portfolios or a SoFi Robo-Advisor might be flagging the stock as a high-risk asset right now. Looking forward, the catalysts for Supermicro are clearly defined but difficult to execute. The primary opportunity lies in the sheer volume of their backlog. With $12 billion in design wins, the demand side of the equation is not the problem. The problem is the cost of goods sold and the operational efficiency. If they can report a stabilization in gross margins during the next call, it would be a massive relief for the bulls. On the flip side, the risk of continued margin compression or further downward revisions from analysts like those at Goldman Sachs could lead to a sustained period of underperformance. The macroeconomic pressures are a factor too. As interest rates and capital expenditure budgets for big tech companies come under the microscope in 2026, the secondary players in the server market like SMCI might feel the squeeze before the giants do. Investors using interactive brokers' fees and platform features to hedge their bets are increasingly looking at put options, as the put-call ratio has shown some bearish leaning in recent weeks. This indicates that while the public narrative is still focused on the AI boom, the smart money is bracing for more volatility. Comment below how many shares of Supermicro Computer you currently hold and if you plan to buy the dip before the February earnings report. When you look at SMCI compared to Apple stock or Tesla stock, you see a much higher degree of sensitivity to the raw hardware supply chain. Unlike a software-heavy company, Supermicro has to deal with physical inventory, global shipping, and the massive upfront costs of building server racks. This is an important detail for anyone using online investing sites or a Fidelity mobile app to track their performance. The business is capital-intensive, which explains why they recently entered into a $2 billion credit agreement. They need the liquidity to fulfill the massive orders coming in, but that debt comes with its own set of risks if growth slows even slightly. The interactive brokers account holders who focus on technical analysis will tell you that the stock is currently trading below its 50-day and 200-day moving averages. This is a classic bearish signal. However, for the long-term investor looking for investment help, the question is whether the current price of $31.70 reflects the true value of a company that is central to the data center build-out. If you believe that the margin issues are temporary and a result of rapid scaling, then the current valuation is an anomaly. If you believe the competition from Dell and Hewlett Power Enterprise is finally catching up and forcing Supermicro to cut prices to keep market share, then the sell-off is justified. To wrap things up, the central insight here is that Supermicro is a victim of its own success. It grew so fast that its internal controls and profit structures couldn't keep up. The expectation was that SMCI would be the permanent king of the AI server market, but the reality is that hardware is a brutal, low-margin business that requires perfect execution. We have seen a massive contrast between the peak of 2024 and the current struggle in early 2026. The stock is at a crossroads, and the upcoming earnings report will likely be the most important one in the company's recent history. Whether you are using a Fidelity brokerage account or the Robinhood app, the key is to look past the revenue numbers and focus entirely on the margins. That is where the real story of Supermicro will be told. The volatility we are seeing is a direct result of this lack of clarity. Investors hate uncertainty, and right now SMCI is defined by it. From the institutional selling to the cautious analyst ratings, the market is demanding proof that this company can be profitable, not just big. As we move deeper into 2026, the winners in the AI space will be the ones who can turn high demand into high returns for shareholders. Supermicro has the demand, now they just need to find the returns. It is a classic high-stakes setup that will either reward the patient or punish the over-leveraged. Keep a close eye on the volume and any pre-announcements that might come before the February 3rd date. Often these companies will drop a hint if the numbers are going to be significantly better or worse than expected. In a market where Nvidia stock remains the gold standard, SMCI is the high beta play that offers more potential upside but carries significantly more baggage. This makes it a polarizing choice for any individual brokerage account. Whether you are using SoFi Invest or the Interactive Brokers platform, risk management should be your priority with a name like this. The gap between expectation and reality has never been wider for Supermicro, and how that gap closes will define the stock's trajectory for the rest of the year. For those who are self-investing and managing their own intelligent portfolio, the lesson of SMCI is one of caution. It serves as a reminder that even the most promising sector can have laggards if the underlying business metrics don't align with the hype. As the market continues to evolve, the distinction between a great product and a great stock becomes vital. Supermicro makes a great product